All right, let's dive into something that, let's be honest, affects every single one of us. The price of, well, everything. We're going to break down some of those economic terms that get thrown around all the time but can be kind of confusing.
I mean, it all really starts with a simple question, right? Have you ever just stood there looking at your receipt for your morning coffee or your groceries and just thought, wait a minute, wasn't this cheaper last month? Why do these prices always seem to be changing?
Well, you are in exactly the right place. Over the next few minutes, we're going to decode all that economic jargon. And by the time we're done here, you'll be able to see the story behind any price tag. So, to make this all super clear and easy to follow, we're going to stick with one simple example the whole way through: the price of a single cup of coffee over 3 years. Okay, so let's imagine this. In year one, your coffee costs a nice, even $3. Fast forward a year, and now it's $3.30. Then, in year three, you notice it's crept up again to $3.40. So, what is actually going on here? The answer to our little coffee mystery. It all comes down to understanding three core ideas. Now, they all sound really similar, I know, but trust me, they describe very different things happening with our money. Let's break them down. First up, the one you've probably heard of a million times: inflation. To put it really simply, inflation just means that prices, on average, are going up. It means every dollar you have buys a little less than it did before. Your purchasing power, it's shrinking. So let's bring this back to our coffee. That jump from $3 in year one to $3.30 in year two? Boom! That's a 10% rate of inflation. Prices went up, and in this case, they went up pretty darn fast. Okay, now for the one that trips almost everyone up: disinflation. This is so important to get right. Disinflation does not mean prices are falling. Let me say that again. Prices are still rising. They're just not rising as fast as they were before. Think of it like you're driving a car. You're easing your foot off the gas, but you haven't hit the brakes yet. You're still moving forward, just slower. Now look what happens between year two and year three with our coffee. The price went up again, right? From $3.30 to $3.40. But that increase was only about 3%, way slower than that 10% jump we saw before. That slowdown, my friends, is disinflation in action. And finally, we have deflation. Now, this is the real opposite of inflation. This is when prices on the whole are actually starting to fall. Things are getting cheaper. The inflation rate has officially gone negative. Just to see what this looks like, let's pretend there's a year four. And in this imaginary year, the price of our coffee actually drops from $3.40 down to $3.25. That right there, that's deflation. The price is now officially lower than it was the year before. So here's the absolute key takeaway. With both inflation and disinflation, prices are moving in the same direction. They're going up. The only difference is the speed. With deflation, the whole thing flips. Prices are actively going down. Okay, so we've got the definitions down, but why does any of this really matter? Why are economists and governments totally obsessed with these numbers? Well, it's because they have this huge impact on everything from your personal bank account to the health of the entire global economy. Now, this might surprise you, but the goal isn't to have zero inflation. Nope. In fact, most central banks, the people in charge of this stuff, they actually aim for a little bit of inflation, usually right around that 2% mark. It's kind of like the Goldilocks zone. Not too hot, not too cold, but just right. See, the idea is that a small, steady, and predictable rise in prices is basically the foundation of a healthy economy. A little bit of inflation actually encourages all of us, people and businesses, to spend and invest our money instead of just sitting on it. And that spending is what fuels the economic growth we talked about in our last explainer on GDP. Because here's the thing, both extremes are really dangerous. If inflation gets out of control, it just destroys the value of your savings and makes it impossible for anyone to plan for the future. But deflation can be even worse. Think about it. If you knew everything was going to be cheaper tomorrow, would you buy anything today? Probably not. And if everyone stops spending, the whole economy can just grind to a halt. That can lead to job losses and even a serious recession. All right, so now that you're basically an expert on this stuff, I want to give you a really simple tool you can use anytime you see a headline about prices, or heck, even when you're just at the grocery store. It's a super simple 3-step field guide. Step 1, just look at the price. Is it higher or lower than it was before? Step 2, if it's going up, check the speed. Is that price rising faster or slower than the last time it went up? And step 3,
Based on your answers, you can name the inflation. See? It's that easy.
So let's just lock this in one more time. If you walk away remembering nothing else, remember this. Inflation, prices are rising. Disinflation, prices are still rising, just more slowly. And deflation, prices are actually falling. That's the whole game.
So the next time you see a price change, and you will, you'll have the tools to understand the bigger story playing out. It's this really cool link between your daily life and the massive forces of the global economy. So I'll leave you with this question. What's the price of your coffee telling you? And these forces don't just move prices around. They also have a massive impact on jobs, which is exactly what we're going to tackle in our next explainer on unemployment. I'll see you then.